All right. So, even though it's not an exact number, I want you to go through the whole process so you guys can have a basic understanding of the formula as well as the logic behind it. And of course, in actual practice, this is more complex than that. But I want you to just give a taste of how this installment sales works and what's the legislation spirits behind each of the rules and regulations of IRS. Okay, so let's get started. So first, for example, this whole operation, sales and the whole package, even though it's not the exact number, let's just assume this is sell as $600,000. But this is an installment sale. Okay, so at that year, you pay a certain amount, and then continue to pay, for example, 4 times. So including this time, and then you're going to pay 3 times. So the whole is 4 times into the future. So basically, IRS defines. So first, is this an installment sale? You have to know that if this is an installment sale. So if you enter into any contracts that say, hey, I'm going to pay you this amount, but I'm not going to give you the exact amount as the first time we enter into this, right? So I'm going to pay this right now, but there is some part of at least one payment in the future after the close of the tax year of the sale. Okay? So that means, for example, you entered in this contract, they pay you certain amounts, and then at the end, the end of the tax year of this exact sale, and then at the new tax year, there is another payment, at least one payment, as long as it's conformed to that certain pattern that is conformed to our definition of the installment sale. Okay, so basically, I pay this, and in the future, in next tax year, I'm going to pay you again at least once. Okay, and then at this specific format, you're going to use the 6252 to file for the years of the sales. And this is very, very important because this will result in future tax return as well. So this years of the sales, you file that 6252, but in consecutive years until all the obligations is fully paid. That means, if someone promised you, I'm going to pay you, they enter in the contract, and I'm going to pay you in, 3 years or 5 years or 4 years. You know what? Until their obligations is fully paid, you're going to continue to report that tax return. You file the tax return every consecutive year after that. And of course, there is some scenarios that the contract is just be disposed of. Okay, and of course, if the contract is being disposed of, the obligations are being disposed of, you don't need to file that again because you are never going to receive that if there is something happened during the fulfillment of the contract. But let's assume that in good faith they are going to continue to pay you until the end of the obligation. So for every consecutive years, you're going to file that. Okay? And let's look at the gain here. So I'm writing gain equals to the selling price minus the basis and minus the selling cost. So basically, the basis is called adjusted basis, and the selling cost is that you got the for example, you hire some lawyers, hire some accountants, hire some tax professionals to get this strategic thing hammered out and then make everything optimized. You know what? That's also considered the selling cost. So basically, it's not that you handshaking yourself, right? Because it's a fairly big business. Even maybe for big companies, it's not too much, but for a start for the small business owners, this is a significant amount, right? So selling cost, you have the hire professionals to help you do that. And of course, after you subtract all that, the selling price, subtract the basis, adjust the basis price, as well as selling expenses. So for example, if there is, I don't know, the basis, you invest a lot into developing of this game, and so you give the estimated price, or you hire professionals to give you the estimate price. So for example, 250,000 US dollars, right? So for example, that's the adjusted basis, and then of course for selling price, you hire someone to do the work. I don't know. Let me just give you an amount. Say the selling cost is 0. Okay. Say you hire me for free. Okay. So for example, the selling cost is 0. And for the future, corporations, the future corporations, the good face, right? The good relationship, we enter into good relationship. So essentially, I do this for free, okay, for 0. Or if you got some like I don't know, 20,000 US dollars, something like that. Doesn't really matter. So basically, you're going to subtract all this cost from the selling price, which is the contract price that you enter into that contract. You can write that. So for example, 600 US dollars. You subtract all that, and then you got the gain. And the gain is like gross profit. Okay? So basically, the gain is gross profits. And at this specific scenario, that's the 350,000 US dollars. Okay? That's your whole total gain. But you know what? You do not actually receive that. Okay? So yeah, I just making all this basis and selling cost up. Okay? So you can change all this much, but as long as you subtract all that from the selling price, you got that. That's the money of the whole gross profit. But you know what? Do not actually receive that at the very, very beginning. Okay, that's the reason why the installment sale need to be considered, and every year need to be considered, because you do not actually receive all these profits at the moment where you enter into contracts. Okay, but why do we need to calculate that? Because we can calculate the gross profit percentage. So basically, you're going to get the 350,000 US dollars, right? You divide it by the contract price. So for example, the contract price is 600 US dollars, and then you got that percentage. It's approximately 58.33%. Okay, so basically that's the gross profit percentage. So for this is like a ratio. Okay, so for every dollar, right? For every dollar that you received, and this 58.33% of that dollars, right, is the gross profit. Okay, you receive that. Some of this is just to cover the initial investment as well as the selling cost and all that. Okay, you pay all this the money that you invest and operate, and in order to get that final product, and then this is the percentage that you're going to get. Okay, you're going to gain. You're going to get that profit because you earn more. You're selling more than all this basis and plus and adjusted basis, of course, and of course plus all this cost that you enter and fulfill that contract. Okay, so once you got that, things got very interesting because that's the percentage. And then remember, this taxable gain is the payment multiply that amount, that percentage. The reason we need to calculate the gross profit percentage is that the payment, the installed payment, is not necessarily need to be exactly divided into 3 years, 4 years. It can be, a huge sum amount, right? And a small amount, okay, depending on how they actually run the business and say, because I'm not sure this business is going to work after transferring to me. Maybe you hidden some secret source, right? So I'm going to not just pay all of it or equal amounts. I'm going to pay a huge sum, but there are some money I want, pay later. Okay, or I just pay you small amounts, and because I say I buy not only the whole business but also the team, right? I hire the team as well. So I'm going to continue to say, hey, whether you like operate good enough. So I'm going to give you all the huge sum later as installment payment. So remember, every time you got paid, you just used that payment multiply the gross profit. So that's the gain of each of the dollar that you received, and some of it is paid off the initial cost of that whole operation, and then that's more amounts remains will be the taxable gain. Okay, for each of the dollar you received, you got that percentage, and then you calculate the gain. That's the standard formula. Actually, that's a standard formula provided by the IRS material. Okay, IRS constantly got the publications, and there's a treasure trove that you can get a lot of information from that. Okay, and for each of the payments, okay, so for example, for this $600,000 US, so if they're going to pay, say, in 4 years, so for every year you're going to pay $150,000 US, okay, because that's divided into 4 years. Okay, so for every year you're going to receive, this is like equally divided scenario, you're going to multiply by the 58.33%, okay, and that will give you approximately this scenario 87,450. Okay, that is the each of year's gain, and that is the results aligned with the installment computation on the form 6252 part 2. Okay, and that's the first year's report. You're going to enter this amount into that form, and remember, it's installment cost, so you're going to report every consecutive year until the application is fully paid. So continue reporting each of the year. You have to report that. This is taxable gain. And of course, there are some scenarios that you can say, hey, I don't care, I don't want, right? I can electing out if you actually desire that. But come on, nobody desires that. You want to pay less right now until you receive that money. But of course, you can using installment methods, or you cannot use that. You can opt out. You can just elect out of this and say, hey, I want the full gain, and then I'm just file the return for the year of the sale. I sell that, I got all that, it's done. Okay, yeah. But I just don't think that's the good idea. But of course, that's your right. Okay, so you know what? That's the basic calculation. Hope you guys through this formula logic, you need to understand which of the steps and why you are doing this.